Hello and welcome everybody to another Capital Gains Tax Solutions Mastermind Masterclass, which takes place every Friday. My name is Brett Swarts, and I'm the founder of Capital Gains Tax Solutions. And each and every Friday, we like to dive into live deals, share stories, and give advice and thoughts on the marketplace and what's going on with exit planning. We believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options, and not having a clear plan and a team to help to execute that plan is the enemy. And using a proven tax deferral strategy, such as the deferred sales trust, sometimes using a Delaware statutory trust or even a 1031 exchange, is an amazing way for you to create and preserve more wealth and unlock the freedoms that you desire. And so in today's initial topic, we're going to be talking about how to build an effective capital gains tax exit plan. And I am joined by some of my strategic alliances who are amazing individuals, including the Jake Miller, financial advisor, certified financial planner. Jake, how are you today?
Doing wonderful, having a fantastic time, and happy to be here to talk about the deferred sales trust and maybe help a few people reinvest with the gross proceeds rather than the net after taxes.
It just makes sense, right? It makes sense. It's the law of compounding interest. If we can keep the money working for you and your family and invest it into different business ventures, not only does it grow the economy and create more jobs, but it also helps you to create and preserve more wealth. And so I'm going to give a brief little presentation today that I've worked on this week. And it's talking about how to build an effective capital gains tax exit plan using a proven strategy or proven strategies. And effective is the key word here that we're focusing on today. In this world, Jake, I don't know if you've seen the movie Meet Joe Black, but there's a scene where it's Joe Black, who represents death, and Anthony Hopkins, who represents, I think, a lot of wealth and an entrepreneur and building a big business, family legacy. And then there's another guy that they're negotiating with in this scene that's kind of trying to take over the company, if you will. And in this world, nothing can be certain except death and taxes is kind of the thought here. But with that, I want you guys to think about capital gains tax is typically 25 to 50% of your proceeds. And that's a lot of money, right? It's a lot of money. It's a lot of wealth that you've built up to know that perhaps at the close of your 10, 20, 50, $100 million property, that 25 to 50% is going to go into tax. It doesn't have to go, but if no planning is done and no strategies in place and no clear vision for your wealth, guess what? Where focus doesn't go, right? Things go into a state of chaos, right? Or where energy doesn't go, where your focus goes, energy flows, right? So we want to make sure that you're increasing your vision and your intensity when it comes to your exit, because you can build something up for many, many, many years just to see 25 to 50% gone in an instant at the close of escrow without proper planning. And so thinking about the thoughts of effective, what is an effective capital gains tax exit plan? Financially speaking, let's start with that, and then we'll go into personal, okay? Because I think it's important to have both, right? So I actually asked our good friend ChatGPT-4, and I asked it in the context of like a DST of what makes the DST an effective way to have a capital gains tax exit plan. And here are some of the answers. And I amended them a little bit, I cleaned them up a little bit and shortened them a little bit. But here's the first one: capital gains tax deferral, right? That is obvious. We want to make sure we're deferring 100% of the capital gains tax as much as we can with the deferred sales trust, and or eliminating the estate tax, which we'll talk about here on item number 4. But that starts with the very first thing. What are you paying in tax? State, federal, Obamacare. In California, you're looking at 37% minimum, and then with depreciation recapture up to 40, 45%, 50%. If you're selling a C Corp, it can be as high as 67%. So the first thing that makes an effective capital gains tax exit plan financially is simply the ability to defer capital gains tax. In other words, keep the money working for you, an extra 25 to 50%. And this is on the tax of the sale of any asset too, by the way. You want to make sure that the tax strategy the asset that you're selling has a strategy that applies to it. The 1031 exchange does not apply for anything except for investment real estate. Same thing with the Delaware statutory trust. And so for an effective plan to take place, you want to make sure that the actual strategy actually works for the sale of your asset. What kind of assets are we talking about here, Jake, when we talk about any asset of any kind?
Absolutely. So, Brett, any asset of any kind that is subject to capital gains, you can use a deferred sales trust. Again, we need to make sure that there's enough tax paying for it to make sense to involve all these new people in this new structure. That's always the conversation with an accountant or an attorney. Does the need, or the economic need, warrant the expense? And of course, should it warrant the expense, then everything else is a little bit easier to identify. Is it an intangible or tangible asset? Is it a digital asset? Is it physical? Is it a racehorse? Is it inventory? What is it? And from that point, contractually, what do things look like? The attorneys dive in as the neurosurgeons just to analyze every small little detail. But from a super high level, any asset that is highly appreciated and you'd otherwise pay capital gains on, we typically can use a deferred sales trust for.
That's exactly right. And any asset of any kind includes cryptocurrency, includes businesses, it includes primary homes, it includes C Corps, S Corps, LLCs, it includes stock, public or private. It includes, of course, commercial real estate. It can also save a failing 1031 exchange. And so any asset of any kind that has at least $1 million net worth, $1 million net proceeds and $1 million gain qualifies. Now, if you have two at $500,000 each, yes, we can use the deferred sales trust to combine those two, but generally we want to make sure it's big enough to make sense of it. And by the way, when do you start paying tax? Well, when the seller, the taxpayer actually receives the payments. Typically at the trust level, the trust is operating at a loss because it can expense what it owes to you. The way the deferred sales trust works is that you are lending funds, lending the equity that's owed to you to the trust in exchange for the trust to pay you back slowly over time. In other words, you're becoming the bank. And as you receive payments from the trust to you, you pay tax. But at the trust level, it's typically able to expense what it owes to you. And therefore, it's operating at a loss year in and year out, even though it's actually earning interest and earning wealth inside of the trust, which is really amazing. Which leads us to number two. I'm going to bring in Jake Carpenter. It's investment opportunities, right? And this is the key here, the freedom to invest the funds in any asset of your choice. Jake Carpenter, without restrictions or timeframes for investments to be made. Talk about the value of diversification and the value of time being on your side when it comes to the deferred sales trust.
Yeah, Brett, what you have a lot of times coming into the deferred sales trust is an over-concentration, generally in the real estate market, whether it be geographically concentrated or whether it be asset class concentrated. Generally, it's both. So what we are able to do is take maybe a $10 million, $20 million asset, and upon the sale, the proceeds fund into the trust. We can then develop an investment strategy through the risk tolerance of the original seller and get those assets to diversify both geographically within the country and through asset classes. Maybe we can mix multifamily with medical professional and some light industrial mini storages, stocks, bonds, and mutual funds, treasury bonds, things like that, to create an asset mix that the seller is comfortable with. And of course, the seller works with the trustee and myself or Jake Miller, financial planners and investment advisors, to come up with an asset mix that is comfortable for them. And a lot of times, since our clients are very heavily into real estate and hard assets, most of us are trying to put together an investment strategy that continues to follow that and stay in the real estate markets. My clients tend to not like to be heavily in the stock, bonds, and mutual funds unless it's to create and maintain enough liquidity for them to stay on the sidelines, stay conservative, and have a chunk of capital ready to deploy into another actively owned and managed strategy that they can partner up with the trust on.
Awesome. Jake Carpenter. Jake Carpenter is a financial expert, advisor, securities advisor in the state of Washington. And I like what you said there, Jake. You said, look, they're typically coming over a highly concentrated, equity position or wealth position in either real estate or a business. And it's, represents 50, 60, 70, 80, 95% of their net worth. That's highly concentrated. Maybe, in that scenario, it's defined as over concentrated. Now, as an entrepreneur, as an owner of real estate, we love to be in control and we love the ability to build wealth on our terms. And what's so unique about the deferred sales trust is not only can you diversify, like Jake said, geographically, but also asset class, but you can also diversify the time frame in which you invest. Meaning it's not all right now. Now you can sell high. This is the beauty of it. And we're coming up a 12, 13-year bull market financial market. Now things are definitely on, shaky ground for a lot of things. And so the question is, can we capture your high value right now for the asset you're selling and then be in a position to preserve the wealth? We believe right now is the best time to preserve the wealth. The last 12 to 13 years has been one of the best times to create the wealth. And now in between, let's say, these two marketplaces of a shifting market, you have an opportunity with the deferred sales trust to, basically lock in the asset value or the equity that you've earned, not only defer the capital gains tax, but then diversify, put the preservation in place, safer places like industrial properties, multifamily, maybe buying stocks at a discount, T-bills that are fixed and, backed by the U.S. government. You have the ability to go back into real estate or businesses that make sense for you, but it's at your timing. And that's so key. Which then moves into, after you're in the preservation mode, to wait and see kind of thing where a lot of people are at, then you can create again, right? So we believe the deferred sales trust or an effective capital gains tax plan is only as effective as the time in which it gives you to make great decisions, to build the business on your terms, the real estate on your terms, to buy, negotiate on your terms, not under these strict timelines. So important for that, which leads into the next point. To build a effective capital gains tax exit plan has to actually do with the payment structure itself. You want to make sure you have flexible payments back to you. And we call this tax flow. Tax flow. It's not just about cash flow. It's about tax flow. And the ability to build wealth is not how much cash flow comes in. It's actually how much you get to keep, and that has to do with tax flow. Now, tax flow is basically, the way we define it, is having optimal depreciation schedules, which allow you to not only offset the tax, but also structures where the payments can be made over a long period of time. In other words, let the money compound inside of the vehicle, sort of like an IRA or 401k. Even like a 1031 exchange, you have the ability to defer that tax, grow that wealth, let it compound and build in your favor, and then try to get some depreciation to offset it. And so the deferred sales trust is perfect for this because it establishes a new basis if and when you partner with the trust. And that new basis, that fresh basis, of which about 80% of it allows you to be used for your personal, if you're an active investor in this investment, to offset the cash flow. So important. Whereas the 1031, the old basis travels, which leads into point number 4, estate tax benefits. I kind of mentioned at the beginning, but this has to do with the 40% death tax. So if you're ultra high net worth or you're selling a company for 10, 20, 40, 50, $1 billion, your biggest problem is not capital gains tax anymore. It is estate tax. And estate tax is basically anything above and beyond 24 million married, 12 million single or so, 14 million with adjusted for inflation right now. But in 2026, set the cut in half, which means anything above and beyond that, it's the government's biggest mousetrap, as Jake Miller likes to say. 40% of it's gone. Has nothing to do with the stepped up basis. And so if you've been told about the 1031 exchange being the end all be all, especially for real estate owners, which again only works for investment real estate, doesn't work for primary homes, crypto, or business sales, you haven't been lied to. It's really good for the stepped up basis, but they haven't told you the full story, or maybe they don't even know the full story. They're not looking out for the entire estate, which most clients, before they find us, they're buying a bunch of life insurance. They're having to give it all away to charity or try to have a bunch of kids to gift it away. Guess what? We have a solution. It's the Deferred Sales Trust Plus. We eliminate the estate tax. We give you a new depreciation schedule, which makes it what we believe is the most effective capital gains tax exit plan for those that are looking to exit outside of the taxable state. The last two ones are asset protection and debt freedom. The fact that you don't own the trust creates asset protection, which is great. What does that mean? Well, that means if you got sued, say you own a property or you own an asset in an LLC, even, it's limited to the liabilities limited to that LLC. But if you sell the equity that's from that LLC to the trust in exchange for a promissory note, what you own is the promissory note. So by definition, someone cannot sue and take what you don't own. Now, what owed to you, they could potentially get a judgment on the payments, but they can't force the exit of the asset, which is so important to understand. Number 2, debt freedom. Right now is a great time to be out of debt, and the deferred sales trust gives you that versus the 1031, which you have to go back into assets with equal or greater debt. So I talked about the financial aspects, right? That we just covered that. Okay, so now let's talk about the personal reasons you have an effective capital gains tax exit plan. And this has to do with, we work with clients all the time, and we always say we can give you the financial reasons to sell something, but the personal reasons you have to figure out and clarify for yourself. But here are some of the major ones that we believe make an effective capital gains tax exit plan. And I'll ask Jake and Jake to think about one of these that really stands out for them. But let me just kind of give a quick overview, and then I'll go to Jake Miller and Jake Carpenter. So the first one for an effective capital gains tax exit plan personally for our clients, we believe, is time freedom. Time freedom is a one commodity we can never get back. So one thing that we all have the same amount of, we don't necessarily all have the same amount of time in our lifetimes, but as of today, if we have today, that's all we have is 24 hours. So how are you spending your time and energy right now? Is it where you want to be spending your time and energy? Is it how you want to be spending your time and energy? Is it in the business or the real estate or the toilets, trash, and liability that's causing the headaches? That's causing the stress? Is it maybe wanting to spend time with instead of your toilets, trash, and liability? It's like Warren and Catherine, who helped sell their $2.5 million deal in Sacramento, spend time with their two twin daughters who are 10 years old. And, they're 8 years before they're maybe in college, and they don't have as much time to spend with them. And instead of driving multiple hours to spend on the property, toilets, trash, and termites, those 3 T's, they keep spending with their 2 T's, which is their twin daughters. And so you really want to clarify, do an audit of your time and the multiple millions of dollars that you've earned or built over the years. If it's serving you the way you want to be spending your time, fantastic. But if there's a way to unlock time freedom, the deferred sales trust is an amazing way to do that, because you can become a passive investor. You can get passive cash flow, and you don't have to have the liability and the time it takes to run a property or a business, or even own a big primary home, right? Where you feel like you're stuck, which is location freedom on the bottom here on the left, location freedom. Maybe you want a new place to live, but that asset or that business is holding you there because of the active management. Well, the deferred sales trust is great because, like Jake Carpenter said, geographical freedom with the investments. It doesn't have to be inside the same asset class. In other words, you can replace that cash flow in other investments within the trust, and that gives you the ability to travel and do whatever you want or move somewhere else. We also have, I'll actually pass it to Jake Miller now. Jake Miller, of the ones I haven't mentioned yet, which one really sticks out that you feel like is so effective for someone who's building a capital gains tax exit plan?
Just essentially being able to accomplish their goals and objectives more efficiently. A lot of times people have their goals and objectives and they're dumbing them down to deal with the tax ramifications. And with the deferred sales trust, they don't have to dumb them down anymore. They can actually realize with the gross proceeds minus attorney fees rather than minus taxes, the ultimate or the optimized scenario for their goals and objectives. And so whether that's time or whether that's any of those other number of items that you mentioned, charitable giving, everything else, it all fits into place better because it's a lot easier for them to visualize their estate from the numbers that they're seeing right now, rather than visualize their estate from the numbers they're seeing minus taxes. Because just like the Joe Black and the movie, 25 to 50% of your taxes go to capital gains, or you lose it because of capital gains tax, etc. Now they don't have to have that uncertainty.
Very well said. Jake Carpenter, of the ones that are left on the screen before, which one really sticks out for you?
I think one of the ones that's a significant consideration to a lot of the folks I talk to is partnership freedom. Because when you're in partnership with somebody that maybe, it doesn't quite click with, you partnered up with someone, it was successful, you've got a significant asset value now, you want to go your separate ways. I have seen people pay up to 50% capital gains tax in California just to say goodbye to that partner. And the deferred sales trust gives you the freedom for one partner to walk away and the other to stick with it or do something else and pay the tax. And so I'm actually struggling with that with a 1031 exchange right now, where they would like to go their separate ways, but they should have done a few things to do what do they call it, a drop and swap, right? So restructure and then give themselves enough time so that they can 1031 and go their separate ways. But with the deferred sales trust, they can actually do that at the sale, and one of them can pay the tax, or one of them can have their own trust, the other one can have his own trust, they can invest differently. They can have different investment strategies. They can decide to go different directions. So partnership freedom is huge. Even if there's 2, 3, 4 partners, you can all choose to do separate things.
Yep, I think that's so well said, Jay Carpenter. An effective capital gains tax exit plan is going to serve you best. It's going to be effective to the extent that you can be spending the time and the energy with those you want to be spending time with. And by the way, not all partnership breaks are bad. It could just be different seasons of life. One partner could be ready to retire. One's ready to double down on the business venture. And 20 years ago, when they first started together, they had different, they had the same vision. Now it's a little bit different, and that's okay.
We've had the different is exactly what the situation was. It's a younger guy with an older gal. They have skills that complement each other. But now they've had a successful partnership, and she's ready to retire and he's ready to push forward. So well said.
Yeah, exactly. And the deferred sales trust gives them both the opportunity to go separate ways. Each of them can have their own deferred sales trust, right, which owes them the money, but they're not commingled together. In fact, all of our trusts are never commingled with any other trust. It's only ever a single individual or a married couple that have each per individual trust. And that's how we keep transparency and accountability and everything that keeps it in line with what you would want. So they can go their separate ways. We've also seen deals where a partner may buy a partner out, keep the business, and the other partner just assigns their interest to the trust. So it doesn't necessarily take a sale of the entire business. It could just be their interest in the business. And that is so powerful. And that's such a great way to build an effective capital gains tax exit plan. By the way, if you want to learn more about this, you can go to capitalgainstaxsolutions.com, capitalgainstaxsolutions.com. You can also connect, that's with me, if you connect with Jake Miller by going to strategictaxsolutions.com, strategictaxsolutions.com. And Jake Carpenter is carpentercapital.llc, I believe, carpentercapital.llc. So let's continue on here. I think we have a pretty good momentum on building this effective, capital gains tax exit plan. Let me grab up the screen again. 1 second here, as I just grab this and keep on presenting. So 1031 freedom or rescue. To build an effective capital gains tax exit plan, you want to make sure you have a backup plan in case your 1031 fails, right, or is failing. And so without having to identify the 1031 exchange or identify the deferred sales trust inside the 1031 as a property, because it's not a property, as long as you work with us prior to close of escrow and you're working with the qualified intermediary who is our #1 strategic alliance for this, we have you covered. And that's neat because it's kind of like an insurance policy in case the 1031 fails to go into the deferred sales trust. But essentially, you don't have to pay anything for the deferred sales trust unless you use it. So that's really valuable. Also works for short-term or long-term gains. An effective capital gains tax exit plan also works for both short and long-term. By definition, a 1031 exchange only qualifies if you owned an investment property for more than a year. Okay, and so important that the deferred sales trust can work for short or long term. It can also work for less than a year, as well as primary homes, whereas in the 1031 scenario, you'd have to move out of that house for a year or two, establish it as a rental, and then roll it into another 1031 investment property. It can also be flexible for the estate plan. We believe that, just like kind of talking about the partnership, a lot of families we work with really want seamless passing of their wealth to their heirs in a way that doesn't create a lot of stress for the family. What does that mean? Well, that means that the trust, you can sell the assets now. And so instead of, sons and daughters, maybe arguing over what should be sold and when and how, a lot of times, a lot of our clients, they have one son or daughter that's like the main person who's been with them, helping them to build the wealth over time. The other kids maybe are a little bit not as interested, but they still have some different interest in selling when it sells. Well, instead of having them potentially argue over that, you can sell the asset today, defer the tax, have a cash flow coming from the trust that upon your passing, if you're married, your spouse passing, pass seamlessly to the kids. Just the cash flow itself. So there's no having to argue. Or the other thought is, a lot of parents, they're like, look, I built the business or the real estate. My children aren't involved really at all. And I don't want them to, drop the ball upon my passing and try to sell the asset when they don't know how to negotiate or work through the complexities of selling it at the highest price and the best terms. And so the deferred sales trust gives you that flexibility for estate planning to take care of it today and then just have the cash flow passed to kids accordingly. Okay, pretty cool. So what is the most effective capital gains tax exit plan? Well, we believe the one that combines both financial and personal freedom and the impact that you desire. Sometimes that is the 1031 exchange. Sometimes that's a Delaware statutory trust. Sometimes that's the deferred sale trust, and that's a donor advised fund. Sometimes it's a mixture of all of them. Now, the impact has to do with not only your family impact, but also for, maybe giving to causes you believe in most, right? Or making an impact with, funding multifamily housing projects that helps to solve the housing crisis in America. It can be a number of things, but the key is, if you're listening to this, is you want a team and you want a strategy or strategies that gives you the personal freedom, the financial freedom, and the impact you desire. You don't want to settle for just one. You really want to combine all of them, or maybe you do settle for one. Obviously, or we're a little bit biased, although we're definitely open-minded, but we do believe the deferred sales trust is the most effective way to do this. A cornerstone is the way that Jake Miller puts it for your financial plan. So why is now the time to go all in with the deferred sales trust? Well, the stats don't lie. The stats are really staggering. In fact, there's $84 trillion set to pass from the baby boomers to the next generation, which is the largest wealth transfer in the history of the planet that we know of. And in fact, 77 million baby boomers in the U.S. alone are here. And every single day, 10,000 are retiring, turning 65, or not necessarily retiring, but turning 65, at least the retirement age. Now, 50% of the total net worth in America, this is kind of interesting, right? Think about this. It's tied to high-end primary homes, businesses or private equity, and commercial real estate. Now, these three asset classes that represent 50% of the total net worth in America are highly appreciated with the baby boomers. On top of that, they're illiquid. By definition, they're not diversified. So this 84 trillion, if you cut that in half and do some simple math, 84 is probably not all of the baby boomers, obviously, right? But a large percentage of it is. That's a lot of wealth that's going to pass to the millennials. And the question is, what's going to happen? And this is why we think it's the best time to go all in with the deferred sales trust, because of the flexibility for your financial freedom, for your personal freedom, and for the impact that you want to make. So who is the deferred sales trust for? We mentioned this a little bit ago. If you have $1 million net proceeds, $1 million gain, fantastic, you qualify. But it works for crypto owners, NFT, private stock, public stock, businesses, LLCs, S Corps, C Corps, partnerships, investment real estate. You can save a failing 1031 exchange. It could be GP or LP interest, artwork, captive insurance, carried interest. Okay. Who is it not for? And this is really important. Jake Miller, who would you say it's not for? Based upon this screen and just kind of what what would you say the deferred sales trust is not for?
It might not be for you if your transaction is less than $1 million. Simply, if the capital gains on the transaction is $1 million or greater, then it's a no-brainer. That could be a transaction of 1.2 where your basis is 200,000 and your gain above your basis is $1 million. If you don't have unilateral control 100% of the time, well, anyway, just reading through some of these, right? Somebody else who is more concerned about leaving the asset that they currently own rather than leaving the value of the asset to their heirs, it is not a good fit for them either. And simply put, your goals and desires with the proceeds ultimately determine whether or not the deferred sales trust is a good fit. If your desire is to spend it on personal stuff and to not have to worry about a trustee and to not have to worry about another entity, other structures, then the deferred sales trust is not for you. But it could be for you should you wish to reinvest the gross proceeds of the sale of whatever asset in other assets. If you're not looking to spend it now, but you're looking to reinvest and grow your overall net worth, then it could be a good fit. But again, not a good fit if it's not a big enough tax payment, not a big enough transaction, not a good fit if you really don't want to sell that thing. I mean, to qualify to be able to use the deferred sales trust in the name of the trust itself, it says sell. So you got to be selling something. And then, of course, your desire or your wishes with the proceeds. What do you plan to do with what you're selling?
That's a good point. Bring up the trustee, right? By the way, if you have, for those who don't know, I'm a deferred sales trustee. It's our company, Capital Gains Tax Solutions. And I have a thought to that, right? Because I call it choose your control, right? You can have 100% unilateral control after tax, right? And so let's say you have a $10 million exit, you could have 6 million unilateral control, or you can defer that, which is the government's money, that other 40%, right? You can defer that. And with working with our team, with the Jake Miller, Jake Carpenter, myself, we can not only defer that, and you have indirect control, but we can use that to grow your wealth, right? Grow your wealth. And so I'm working with an apartment owner right now, considering the deferred sales trust. And I think the biggest thing for commercial real estate owners and even entrepreneurs too, we're so used to having unilateral control. That's how we have been successful to build wealth over time. And so upon the exit, it's very hard because that's what we built up for, right? And it means so much to all of us. And part of our core values is being great stewards. And we thank you, all of our clients have entrusted us with to be great stewards with the capital that you've entrusted us with and the responsibility that entails. But that being said, you can partner with the trust where you're back in, really, I don't know if say it's completely a unilateral control. I mean, it's a partner, it's the trust that owes back the money that owes you. But the scenario of a $10 million exit, that you would have paid $4 million of tax. We did the scenario, the 10 million goes into the trust, and we form an LLC a week or two later, and you find a property to invest into. The $4 million that you would have paid goes into that LLC, which you're the managing member of that LLC, and you're running that asset, you're buying that asset with the LLC. That's an extra $4 million that you wouldn't have had. The other $6 million could be in a diversified portfolio of liquid investments or other real estate investments too, right? Passive or active, or other business ventures. We definitely want to keep about 20% liquid to keep kind of like reserves, if you will, but still an investment, still earning interest. So there are some things. It's not perfect, right? No strategy is perfect, but if you think it through and you have a team to help you execute this, it actually becomes a way to build your wealth, not just preserve it, a way to create your wealth, not just defer tax. And that to us is an effective way to build a capital gains tax exit plan. That being said, we've been through about halfway through the presentation. We're going to cover the next half next week. However, we want to open it up for questions or thoughts from our guests on the webinar today. We do have we have Christina, we have Luis, we have Ted, we have let's see here, Asif's. These look like some of them are otters taking notes here. Maria. So anyone have questions? And Ted looks like a new name. Ted, hello, Ted. If you want to say hello, we'd love to hear where you're from and see if you have any questions or thoughts on anything that's just been said. No worries if not, don't feel pressured, but we always invite our new guests to say hello. That's okay. Luis, did we have Luis last week, Jake? I'm not sure. Luis?
Yeah, hello.
Oh, hi, Luis. How are you, sir?
Good. And you? I was in the last meeting, but I jumped in kind of in the last. I missed 10 minutes or so, so I said let me start all over from the beginning, and this was a nice opportunity to hear from the start.
Likewise, Luis. Where are you calling from, and what questions or thoughts do you have so far?
From Florida. I'm a real estate developer, and I got a lot of those opportunities that you mentioned of the concerns about the exit. So definitely I want to be learning a little bit more about it.
Excellent. Do you have a live exit that you might want to just kind of strategize with right now for everybody, or just hypothetical exit? Do you want to kind of walk through the scenario with the deferred sales trust and how that might fit?
Yeah, so we develop from ground up multifamily buildings, generally partnering with limited partners, but we kind of get a smaller chunk of the initial capital, but higher on the exit, right? So we get usually 30% of the proceeds that exceeds 8% IRR on the deal. So let's for the sake of calculating, let's say we got 25% of the equity of the deal on the exit. Usually it's a sale for institutional investor, and there's a big capital gain.
Yeah, excellent. So it sounds like the GP shares that your exit is about 25% of the deal. You build it from ground up. You have LP investors, and it's a large exit. And every time you're exiting, you're probably just paying the LPs back. You guys, the GPs, you guys pay your tax, and you do the next one is what you've typically done. Is that a fair summary so far?
Yes.
Okay, excellent. And so I'll give you a deal story, and then we'll walk through what could be possible for you. So we just recently did a $48 million exit in Nevada. It was a multifamily property. It was the fifth exit for David Sloan, a client of mine out of California. And for him, was doing the same thing. He wasn't building, but he was buying existing and then would improve it. And he and his partner Jordan were the GPs, and they had a lot of LPs. And so for the longest time, they would just simply pay their tax. And so their LPs. And now sometimes that would work out because they would buy an asset and they'd be able to cost seg the next one and it's fine, right? But a lot of times it wouldn't work out for the timing. And they also wanted to diversify. But they also wanted to use the same funds to go back into their next deal. And so enter the deferred sales trust. It really had to solve those three things for them: defer the tax, diversify, but also be able to go and use the funds to fund their next deal. And that was kind of a no-brainer for them. So as they exit each of their GP positions, they're doing just that. And so to clarify, you can set up a trust. We would set the trust, and you could the trust could be sold. You could sell your GP interest to the trust. They're typically LLCs, right? But it also works for S corps and C corps. But I'm imagining yours is probably an LLC structure.
Correct.
And we could assign your interest of your LLC to the trust in exchange for a promissory note. It doesn't affect any of the other sellers. Your other GPs could do it or not do it. They could have their own. The other LPs could do it if they had $1 million net proceeds, $1 million gain of their own. In fact, the last one we did with David, we had a $3 million LP who did that exactly right. He did that exactly what I'm saying. He had his LP interest go into it. And then once it's deferred, they get a promissory note back somewhere between 6 and 9% to pay them back slowly over time. Now you're in Florida, right? Florida is one of the better capital gains tax states. No state cap gains tax, but there's still federal and Obamacare. So that's about 24% and some depreciation recapture. So as long as your debt's not over your basis, Luis, we have an opportunity to not only defer that tax, diversify that wealth, but then you can partner with the trust to put it into your next project. As a developer, the biggest challenge with developers is the fact that they typically are not 1031 exchanges. And the reason is they're buying land that is not equal or greater value, and they need the money to develop the property, which means typically if they're selling a $50 million asset, they're buying land for maybe $3 to $5 million, and they're using $20 million to build it. The 1030 doesn't work because it's not equal or greater value and it's not within 180 days, right? And so the deferred sales trust is perfect for a developer because not only can you sell, defer the tax, but then you can turn around and use the funds that would have been paid in tax to develop your next project. So that's how you build an effective capital gains tax exit plan. Luis, any thoughts in there, and maybe fill in the gaps that I might have missed?
No, just want if there's any restriction for foreigners, because a lot of the LPs here in Florida are foreigners and they might be interested also in the solution.
Jake Miller, what's your thoughts on just international and work with the DST? And I'll just come out and say there's no restrictions, but I want Jake to kind of fill in on that. Jake, go ahead.
Say the question one more time, Brett. I had a little bit of noise on my.
Yeah, he was talking about foreigners, just how the deferred sales trust works with foreigners, right? Foreign nationals or just, maybe not in U.S. citizens, just investors, the value of the DST and how we work as a team with yourself as well with folks that we work with.
Absolutely. No, I mean, one of the biggest transactions that was actually audited by both the IRS and the state of California was by a foreigner, an Italian, who owned a $120 million office building on the shores of California. And at the end of the day, everything worked out great. And it did because of a trustee and of the team that we put together. Whether you're a foreigner or if you live domestically here in the United States, what have you, it pretty much works out the same. There are a few intricacies being a foreigner, as you're probably very aware. We actually have people in my office that help individuals who are foreigners get what's called an ITIN if that's needed. With an ITIN, you can then open up entities and have a trust and have everything else that you need. And so we often, and I would say my office more than any other, we work with a lot of foreigners who own U.S. assets.
So the FERPTA kind of doesn't apply, right? Because he sells his shares to the deferred trust, and he's gonna get a loan payback, right? So it's not a capital gain, not a real gain. He's getting a loan.
There's an exchange. And so it's kind of like a wash in the sense that there's an exchange, there's a promissory note for that asset that goes into the trust. And then we keep that from being taxable because then it's the trust that sells that asset.
Okay.
Yeah, but for you to have that promissory note and everything else, we got to make sure that your estate and your legalization in the states for legal standing, so that you can call on that promissory note that you have rights to do that. There's just a few little details to make sure that's all tight, buttoned up correctly, which is not very difficult. It's just, we got to go through the right process.
So the answer is yes, it absolutely works, and in fact, works better. Yeah, Luis, works better because the other thing too is that a lot of foreign nationals, who are not U.S. citizens, they're faced with what's called the death tax above and beyond. For them, the exemption is only like 64, 68,000.
Yeah, it's
And
super
so
small.
super small, right? And so the deferred sale trust is amazing. It can work for anyone, anywhere, as long as the asset that's being sold is subject to U.S. capital gains tax. So the tax code for it's called IRC 453 is one of the parts of the tax code. It applies to any person anywhere that has assets that are subject to U.S. capital gains tax. However, it's extra valuable for foreigners because they don't have that exemption, where we use a different strategy for the DST plus, which eliminates the estate tax, which, let's just say one of the foreign investors, for example, had $10 million of gain and or equity that he built up within the U.S. Well, upon his death, the government will basically take 4 million of that, 40%, minus $68,000 is the exemption amount, which is tiny. If you were a U.S. citizen, then you have up to 12 million, 14 million single as an exemption, or 24 million married. But foreigners don't have that, and so the DST becomes even that much more valuable for them. So it works. Some of the biggest deals have been done with foreigners. So yeah, that I would say we just schedule a call would be the next step, Luis, to kind of work through the steps. What's the timing and the details for your particular fact pattern? But what's the timing of the sale if it's going to happen?
It's usually a 3.5 year process after you got the project approved to build and sell. So typically, the whole cycle is a 5-year cycle between the purchase of the land and the sale of the property.
Okay, what part of the cycle are you in right now?
Right now, approving a project, and another one I'm executing. So I'm kind of in between. So one I got 3 years down the road, and the other one still got more.
Hey, you're doing well. You're pre-planning the plan. This is great. In fact, that's what we encourage everyone to do, is plan their exit plan before they actually have the property on the market. They're selling, they're listing, and all of a sudden, everything's hot and heavy to get the property closed. You want to have the team in place, the strategy in place to execute. Well, Luis, any other questions or thoughts on anything we just said?
I don't want to take all the space, but just one last question. What are the costs for maintaining annually the tax trust?
Yeah, great question. So the first cost is just a one-time fee based upon the gross sales price. We'll keep it simple right now. Let's imagine the sales price of a multifamily property was $1 million. Okay. There's a one-time fee to the tax attorney for $15,000, 1.5% on the first million. If it was a $2 million sale, the second million would be a little bit of a discount, 1.25, so 12,500 on that second million. Now, if your percentage of ownership were a certain percentage, it would be, if you're doing a trust for you, it'd be on your percentage of the ownership with how that'd be calculated. So that's a one-time fee, comes lifetime audit defense. That's paid to the tax attorney or business partner, CPA, tax attorney, law firm. The second set of fees is combined. It's like Jake Miller and I, or Jake Carpenter and I, and it's basically about 1.5% to 2% on a recurring basis, no matter how and where the funds are invested. Generally speaking, right? So if $1 million goes in there, 15 to 20,000, although our goal is to return net to you 6, 7, 8, or 9% compounding net of those fees. Okay, net of those fees. And so we're going to work and invest to do that. And so, that's kind of that's how the numbers shake out. Of course, the ROI is more than just the tax deferral and that 9%. It's also the ability to partner with the trust, get a new depreciation schedule, and build additional wealth within that new LLC that can have additional upside for you. Plus, of course, hopefully optimal timing. There's some with buying properties at a discount because you didn't have to do a 1031. The second thing would be just there's some small miscellaneous fees like a tax return for a third-party tax preparer, but the recurring annual fees is typically we're netting 6, 7, or 8%, 9% compounding net of those fees over any 10-year period of time. Some years are high, some years are low, and every 10 years you can basically renew it for 10 years. You can pass it to kids. Kids can step into your shoes for the DST 1.0, for the 2.0. Kids can be the beneficiaries outside your taxable estate. So that's the answer to that. Any questions there? Is that make sense to you, Luis?
That's perfect. Thank you very much.
Absolutely. You're welcome. And so anyone else has any questions or thoughts, you can either type it in the chat, as well as you could also just unmute yourself and say hello. And we are happy to answer those questions and thoughts. It is 10:43. We've done pretty good today, guys. Jake Carpenter, any last thoughts before we let everyone go, unless someone unmutes himself and says hello?
Yeah, I do have some last thoughts, and this is based on, our personal experiences of doing deals together is, one of the things that seems to hold people back when it comes to the deferred sales trust, which is kind of interesting to me, is the fees. It seems like a lot of people get stuck on the fees, and whether it's $100 million case or a $10 million case, let's take California. You're gonna pay on a $10 million case, you're gonna pay $4 to $5 million in tax. And the deferred sales trust is a 1.5% fee on the first million, 1.25 fee on the additional million. Then of course it's up to 1.5% to 2%, all in for not only Brett as the trustee fees, but for Jake Meller and myself for the advisor fees. But let me tell you, the deferred sales trust strategy in partnership with a team like Jake Meller, myself, Brett Swarts, some of the other strategic partners, this team is amazing. And I'll speak from one of the last deals that we just did. We replaced debt over basis. We funded the deferred sales trust. Jake Meller and myself have been working together with the seller to find investment options. I mean, this strategy truly becomes an asset for you. If you let us work with you and your advisors, we turn this into an asset. And really what happens is the fees for the deferred sales trust are fractional when it comes to paying the taxes. And when you look at all the tax money that you put back in your pocket, that the team here, Brett Swarts, Jake Meller, and myself, along with your other advisors, your CPAs, your attorneys, we can really make that a very valuable asset to not only just produce more passive income to you if you'd like to hit pause, but to grow the wealth and or position you to be able to take advantage of opportunities at the right time, whether that be 1 year, 2 years, 4 years down the road. And all I ask is that if you're here or you know somebody that needs to hear about this, do not get hung up on the fees. Ask Brett Swarts, myself, or Jake Meller, walk us through the fees. Why do you say that the fees aren't an issue? And we're all going to paint a picture for you of how we've truly used the deferred sales trust to create an asset. And really, as Jake Meller puts it, you call it the not the cornerstone, but the
keystone.
The keystone to your planning. The keystone, the one key thing that we can use to build around and create more flexibility, more opportunity. And when you look at it, it's nothing more than creating a huge opportunity for you, because now you can use timing to your advantage. You can use diversity to your advantage. You've got a very professional team that works together. Jake Miller is a financial planner. I am an investment advisor. We work together seamlessly. Not only has he helped my investors in the deferred sales trust, my sellers find investments, but they're also investments I invest in personally myself. And, these are powerful investments. They're powerful team. And it's just really a huge asset overall. So I encourage you, if fees are in any way, shape, or form, if you're getting hung up on those, have Brett Swarts break that down for you, or Jake Meller break that down for you a little bit, because this is truly an asset. It's not a liability. I promise you that.
Awesome. Jake Carpenter, people want to find you. Where can they find you?
Yeah, you can call our office at 509-396-5292 or find us online at carpentercapital.llc.
Fantastic. Thank you, Jake Carpenter. Thank you so much for that was really well said. I appreciate that. Jake Miller, people want to find you. What's the best place for them to find you?
Absolutely. Strategictaxsolutions.com, as well as Brett, I was going to mention one thing that us three here do that a lot of professionals don't like to do is we're more than happy to do a cost benefit analysis on what we charge and what our fees are and see if it isn't an investment for the client. Um, anyway, so strategictaxsolutions.com on the website, you can book an appointment, talk to a member of my team. Happy to talk soon.
Absolutely. And I absolutely love both of these guys. I call them the two Jakes. We actually have a third Jake that you don't even know about yet. If you're listening to this, he's also a part of the team. He's actually a tax attorney that we as one of our business partners. So, but yeah, if you get the Jakes in the room, you're in good shape. And then you add a Brett, make sure they have two T's at the end of the name, make sure it's spelled right. But other than that, I appreciate everyone listening today. I want to encourage you to take action with what you've learned on how to build an effective capital gains tax exit plan. Remember, it starts with your vision for your wealth and what you're trying to achieve financially and personally, right? And once you have that vision and once you have that clarity and you have a team in place, that's the next step, and you have a strategy or strategies in place, you can make a big impact with your wealth and you can unlock the freedoms you desire. And so please consider going to capitalgainstaxsolutions.com. You can also read the new book, Building a Capital Gains Tax Exit Plan, by going to Amazon. You can check out that book. We just hit #1 bestseller for that. That's Building a Capital Gains Tax Exit Plan. Thanks so much, everybody. We'll promise to do better next time. We so appreciate you out there, and have a great